Welcome everyone. Chris Carr here with Freedom Home Loans. We are going to go through the August 2021 monthly market report. I'm going to go ahead and share my screen. We're going to walk through a few things up front about the housing market, forbearance, and where things are headed based on some professional opinions. So as I share my screen here, welcome again, Freedom Home Loans. Chris Carr here. This is the August 21 monthly market report. So I'm going to start off with a quote here. When you have a void of information, emotion tends to drive decision making. There's a lot of void of information and misinformation being put out right now. So our job is to educate and inform you to make smart wealth, mortgage, and real estate decisions. Year over year price appreciation. So percentages are accelerating. If you look over the past 5 months or so, this data is active as of May. So 10% in January and February, up to 11% in March, 13% in April. May is hitting 15% year over year appreciation. That's through the roof. Housing bubble. So this is the big thing. Are we in a housing bubble? I think a more pertinent way to frame that question is, if you are buying a house, is my home value going to decline? All right, I don't think we're in a housing bubble at all. I'll go through a few key features here as to why that is. But if you followed any of my previous monthly market reports, you'll see the trend here of information that I share. So another quote, the chief economist of Core Logic, Dr. Frank Northeft. There are marked differences in today's run-up in prices compared to 2005, which was a bubble fueled by risky loans and lenient underwriting. Today, loans with high-risk features are absent and mortgage underwriting is prudent. Okay, I'll show you how. Mortgage originations with credit scores of 620 or less. In 2006, there was $376 billion in loan originations with credit scores under 620. Today, only 74 billion. If you look at that comparison, it's quite the contrast from pre-bubble or kind of the start of the bubble and the collapse in 2006 as to where we are today. There are very, very strong underwriting requirements today, especially through COVID with self-employed, real estate, business owners, things like that. It's been harder to obtain a mortgage. Here's another quote here, State of the Nation from Harvard University. These outside increases have raised concerns that a home price bubble is emerging. However, conditions today are quite different than in the early 2000s, particularly in terms of credit availability. The current climb in house prices instead reflect strong demand amid tight supply, helped along by record low interest rates. I believe last year we had 16 record lows for interest rates in 2020. 16 times we hit all-time lows last year. We're still, I would say, in the 99th percentile for lowest rates all time. That is helping some of this. So if we look at this chart here, this is the mortgage credit availability. The higher the score, the easier it is to get a mortgage, right? We've I think all heard, if you could fog a mirror in 05 to 09, you could get a mortgage, right? It was super easy. At the peak of the housing bubble, a score of 868. Again, the higher the score, the easier it is to get a mortgage. As of today, post-COVID, you can see the drop there from 1920 and these being more difficult to obtain mortgages. Today is 129. That's almost eight times less than it was amid the housing bubble in 06 at the peak. So are we in a housing bubble? I think not, but let's dive into another way we can make our point here in mortgage debt and affordability. So I love this chart here. It's a little complicated, so I'll spend some time here walking through. So the housing bubble, 06, 7, 8, that is the peak here of this chart. This is the household debt service ratio for mortgages as a percentage of disposable income. Disposable income is the money you have left over after paying for housing, okay? So at the top of the housing bubble, that was very high at 7.2%, right? That's the household debt service ratio as a percentage of disposable income. Today, we're at 3.45, nearly half of what we were amid the housing bubble, and at 40-year lows. So there is a lot of disposable income that's not going towards housing payments. This reflects that housing is still affordable. Looking back at the bubble years, house prices exceeded house buying power in 2006. I'll repeat, house prices exceeded house buying power. But today, house buying power is nearly twice as high as the median sales price. Many find it hard to believe, but housing is actually undervalued in most markets. Real estate is hyper local, so it really depends on the market that you're in. But in most markets, and the gap between house buying power and sale prices indicates there's room for future or further house price growth in months to come. Housing affordability index here. Okay, so you may see in the news, right? Housing losing affordability. Now that is true probably over the past year. If you look at the far right, the higher this chart is, the more affordable homes are. You can see the years when distressed properties dominated the market, homes were affordable. We're not too far off as far as an affordability index where we were in 2014 and 15. We're kind of right within that range. If you go back and look, home prices are more affordable now than they were in the 90s and early 2000s. There's three things that compose house affordability. They are home prices, rates, and wages. Now we know that home prices are probably going to start to taper off, not just decelerate, still continue to go up, I believe, but just slow down. And we know, we really think that rates are going to go up. They can't be near all-time lows forever. So that may drive down affordability in the future a little bit. But look at this chart here where we were for the previous couple of decades prior to the housing crash. So to my point here exactly, affordability continues to decline. So we're seeing a little bit less affordable month over month, but still higher than, more affordable than we were in the 90s and 2000s. So are we in a housing bubble? It's basic, simple supply and demand. We are not in a housing bubble. However, I'll give an analogy at the end of this presentation. We are de-accelerating, we're slowing down. So it's a basic supply demand issue. The main driver of the housing shortfall has been long-term decline in the construction of single-family homes. I'll demonstrate this here in a little bit. That's a big thing that's causing the housing shortfall is there is not enough new inventory or new homes being built to keep up with the demand. Single-family homes, completed units. So this is for new construction homes. 13 consecutive years since the kind of falling out of the market crash here, mid 2000s, 08, somewhere in there, about 08. 13 years consecutive below the 50-year average. We are building homes at a lower pace than we were in the 70s, 80s, 90s, and of course, prior to the buildup of the housing bubble. This is a huge reason why there's a lack of inventory and why homes are appreciating so fast. Now I want to talk a little bit on forbearance, all right? So forbearance was a huge fear, a lot of it media driven, when this started coming out. Originally, 30% of mortgages were forecasted to be in forbearance. The actual top of this, the high, the peak, the most amount of mortgages in forbearance was less than 10% in May of 2020. And today we're at about 3.5%. So significantly less than originally projected. The number of mortgage in active forbearance is now under 2 million, 1.86 million as of July. So if we look back just over a year ago, 4.6 million homes or mortgages were in forbearance. You've seen a pretty consistent and steady decline all the way down to today to about 1.86 million mortgages in forbearance. Now, if you've seen my presentations before, you've seen this slide a few times. This is the cumulative forbearance as these kind of three colors indicate. Green means they're paid in full. 44% of these forbearances have been paid in full. Blue means they've either had a modification or a deferral. So those roughly 83% are in good standing with the mortgages. 17% are still in trouble. So the thanks, Roman. I just saw your comment here. I'm not used to doing the Facebook Live stuff here, but so here we go, the 17%. So Black Knight has projected, they indicate that 10 of these 17%, 87% of the mortgages in forbearance have at least 10% equity. That means if you factor in 3% buyer commission to an agent, 3% seller commission to an agent, 1% for title, that's 7%, maybe some inspection items come up or whatever the case may be, 10% should still be more than enough to sell your home on the open market and be able to at least break even, but probably recoup, at least have some moving expenses to be able to get out of your mortgage, maybe pay off some deferred interest or things like that. So 87% of the mortgages still in trouble, roughly 1.86 million mortgages, 87% of them have at least 10% equity. We're not going to see a wave of foreclosures that come in because of forbearance. So Wall Street Journal, between 2006 and 2014, the run up to the housing bubble collapse and the fallout, about 9.3 million households went through foreclosure, gave up their home to a lender, or sold a distressed sale. 9.3 million households. I like this next slide here, Ivy Zellman. The likelihood of us having a foreclosure crisis again is about 0%. Okay, we don't see it coming. One area where I could see it coming is with these low doc 30-year investor loans. I see possibly investors taking the biggest hit. Regular retail homeowners have significant equity and can sell their property on the open market. So I'm going to go into the last section here is the housing inventory. All right. So you may see some, again, fear-based media headlines and things like that about the boom being over, sales dropping, things like that. So I'm going to go through just a handful of things. Again, my job is to educate and inform you to make smart mortgage, real estate, and overall wealth decisions. Here's buyer traffic in April. Overall, nationally, a very, very strong market across the board. May, it's lightened up a little bit. So I'm going to go back and forth here between three slides. April, the light blue is strong, dark blue, very strong. May, a little bit of loosening. In June, a little bit more loosening. So still strong markets. However, it's slowing down or losing the significant strength that it's had. If you compare the three, you can see from the top left, dark blue, all the way across to a little bit of loosening, where one market in Mississippi, the one state, I guess looks like New Hampshire as well, are stable markets. Here's the monthly showing time index. This is the amount of time that properties have been shown on average. All right, I want to negate the two red bars you see at the left. That was during the initial COVID lockdown. People weren't going out. You couldn't show houses. They didn't know what to do, wear masks, gloves, boots, all that kind of stuff. So besides those, we look at this chart here with the monthly showing time on average per house, 205 minutes of average showing time per house. Still pretty healthy, right? Still above the running average here across the board, but we're seeing it slow down a little bit. Months inventory, homes for sale over the past 2 years. I'm going to focus in on the right-hand section of this chart. You can see from August last year, big decline where we were down to, in some markets, days inventory. I think in Colorado Springs, we hit 0 one time, at least from a realtor that told me at least at one moment in time, we hit 0 days inventory. But we were at days for quite some time. And we've seen since December, January, February, March, April, May, June, we've seen that increase. So inventory is starting to come back, which is a good sign for the housing market. Last 2 slides here about the inventory, existing home sales. So we can see these are existing home sales, right? Not new construction, homes that have already been pre-built or exist. So if you see a headline about prices or home sales declining, it's just 100% absolutely not true. You can see the light blue bar is the home price for each month: January, February, March, April, May, June. We literally have seen an increase just about every single month this year, and have almost beat every single month, month over month, for the past 3 years. So June 2021 has beat 2020 and 2019, and pretty much similar across the board. January, February, March, April, May was pretty close, but for the most part, we are seeing record home sales. Now, on the contrary, new home sales are declining, right? As I mentioned last month, home builders typically rely on the 3 L's, which I hope I can remember off the top of my head, but lumber, labor, and land. Kudos to me, I did. Lumber, labor, and land. It's been very difficult for all of those. And you can see over the past 4 months, we've seen new home sales decline. All right, so just to recap here, appreciation year over year is absolutely through the roof, right? So I'm gonna use an analogy of a car driving down the highway at the end, but right now we are driving 160 miles an hour. We are just flying. 18% FHFA, 15.4% CoreLogic, and 16.6% from Case-Shiller, probably the best one to look at there. But year over year appreciation is through the roof. Another quote, given that the sales activity are coming down, we may be sensing some turn time in the market. We are seeing less prevalence of multiple offers. It's still a seller's market, no doubt. I'll have one slide here to demonstrate that, but it is still a seller's market, absolutely 100%. It may not be the best time ever to sell anymore, but like interest rates, it's probably 99th percentile of the best time to sell a house if you have the certainty of what you're going to do, where you're going to go. It's still a seller's market, but people need to be very cautious how they price their home to attract buyers, knowing that these sales activities are declining somewhat. So we are seeing a little bit of tapering off of these $30,000, $40,000, $50,000, $60,000 over asking price offers. So be careful with how you list how you price your houses initially. You don't want to overprice it. You still want to price it fair, but probably a little bit lower is my personal recommendation. Talk to your realtor if you need one. We can make some referrals, but I would still try to make it a situation where you can have multiple offers. So don't overprice, knowing that the market is starting to slow down and buyers are starting to gain a little bit of traction. Here in this slide, it demonstrates the buyer's market versus the seller's market. A neutral market is 6 to 7 months. We haven't seen that in quite some time, but you can see we're bouncing up off of the bottom probably all time of a seller's market. So we're still in a strong seller's market. However, it's not at the bottom any longer. At a broad level, home prices are no danger of decline due to tight inventory conditions, but I do expect prices to appreciate at a slower pace by the end of the year. Ideally, the cost for a home would rise roughly in line with income growth, which is likely to happen in 2022 as more listings and new construction become available. Okay, that recaps, or that is the conclusion of our August monthly market report. I try to keep these to about 20, 30 minutes. Hope I stayed in line there. The last thing I'm going to do is an analogy. Here's what I think is going on with the market. I believe that we are, an analogy, we are a car flying down the highway going 160 miles an hour. We know the speed limit is 80, but we are far exceeding that. we're gonna start to slow down from 160 to maybe 120. It's gonna feel like we're going way slower than what we are, but we're still significantly exceeding the speed limit and speeding at a very high pace compared to where the speed limit is. So we're going 160 miles an hour down the highway. We're gonna throttle down and bring it down to about 120. So we're gonna slow down quite a bit. It's gonna feel like we're going actually slower, but in the grand scheme of things, we're still going faster than the speed limit. So Chris Carr here, Freedom Home Loans. This is your August monthly market update. Have a wonderful rest of the week. Thanks everyone. Bye.